Hi, I'm Patu from freefincal. Today, let's take a look at the 10-year SIP returns of several factor-based indices and market cap weighted indices, and we find that as many as 5 of these factor-based indices have got a 10-year SIP return, which is at least 2 times more than that of the Nifty over the same period. Now, regular readers, regular viewers may be aware that I have talked about factor investing and strategic indices, smart beta indices in several videos before. And in particular, I have made a video of 2 talks that are available in the channel. And one is called Index Investing Options in India, and this was given to the Tamil Nadu Investors Association in the summer of 2018. To the same association next year in the summer of 2019, I talked about momentum and low volatility stock investing. Both these videos are available in the channel. I've also talked about how to pick your first stock without breaking your head, and I have told you how you can pick stocks based on these factor indices, and I pick stocks based on the low volatility factor index myself, and I've talked about my stock portfolio also in a separate video before. So please explore the channel. I'll try to link some of these videos in the I button there. I keep forgetting to do it these days. I'm just too lazy. So the whole point of a factor index is that it basically combines active investing and passive investing. That is, in a normal usual index, it's market cap weighted. They just look at the market cap of the stock, and higher the market cap, higher the weightage it will have in the stock. Whereas in a factor index, what they do is they choose some kind of active stock selection method, and they build the index based on that. Of course, there are arguments to and against this. I have carried an article by a personal finance expert saying that you can do data mining based on past performance, and you can change the method based on what works. They just choose the method which works better among all other possibilities and create an index with that, and they could change the index midway, the index strategy midway. So there is criticism. The second problem is that the actively traded data for these indices are very low, just a few years, although the backtesting data is available. So when I say 10-year returns, most of this tenure is backtested data, and that's important for you to recognize. And the risk in terms of how much it will fall during a market, you don't know. Of course, you can calculate it. What I'm trying to say is, even though the return is higher, it could actually fall more than a Nifty or any other index, standard index, during a market crash. So there are several types of factors, and I've talked about all these before. I'll just give you an overview. There are multiple posts on factor investing. I'll leave this link to this article in the description box. You can go there and explore, and also explore the videos I talked about. Now, please don't ask me to link it. Please go ahead and search in the channel, or you can type the name and search in Google and click on videos. You should be able to get it. I also publish a monthly momentum and low volatility stock screener. And this month, we identified 5 stocks with momentum even in this market with low volatility in the April 2020 stock screener. So out of there are multiple factors. The most common factors are alpha. Alpha is a measure of higher return with respect to the market at lower risk. And there is a market return used, which is Nifty. And then there is a risk-free rate, or risk-free return, which is used. And this is the 3-month bond return. So essentially, a stock with higher alpha means it has produced excess return than the market at a lower risk, at a lower volatility. Excess returns at lower volatility is a measure of alpha. Low volatility is essentially the stocks with the lowest fluctuations will have the highest weight in the lowest fluctuations in daily returns over the last 1 year will have higher weight in the index. In the case of alpha, higher the alpha, higher the weightage. Then there is a quality index, which is based on return on equity, debt to equity ratio, and change in the profit after tax. There's a quality score which is measured. Then there's a value index, which is based on low PB, low PE, and high dividend yield. Then there's a value score defined. Then there's a momentum, the rate at which the stock moved up in the last 12 months with as much low volatility as possible. Then there's a growth sectors index, which pick sectors that exhibit PE and PB on average greater than the Nifty, out of the Nifty. Then there's dividend opportunity stocks with high dividend yield and so on with net profit. So these are several types of factor indices. Then you can combine these factors. For example, you can take 50% of alpha, 50% of low volatility to create Nifty alpha low volatility 30 index, 30 stocks. Then there are several other factors you can combine and so on. So let's take a look at these returns now. Look at the winner is Nifty alpha low volatility 30, 14.1%. S&P BSE momentum index is 13.6. Nifty alpha quality low volatility 30 is 12.3. Nifty alpha 50 is 12. Nifty alpha quality value low volatility is 11. Nifty low volatility is 10.9. Nifty mid cap 150 quality 50 is 10.7. Nifty 200 quality 30 index is 10.6. Nifty quality low volatility 30 is 10.3. Nifty 100 low volatility 30 is 9.6. Nifty next 50 is 7.8. Nifty large mid cap 250 is 7. Nifty large mid cap 250 is 50% of Nifty 100, 50% of Nifty mid cap 150. Nifty 100 equal weight is 6.6%. Nifty 50 value 20 is 6.5. Nifty growth sectors 15 is 6.1. Nifty 50 is 5.5. Nifty dividend opportunities is 4.8 and Nifty 50 equal weight is 2.4. So notice that Nifty 50 is 5.5. Nifty 50 equal weight is 2.4. That tells you how only a few stocks have governed the Nifty over the last couple of years. Whereas Nifty 100 is 6%, but Nifty 100 equal weight is 6.6. So there the disparity is not as much. And so that's essentially it. And if you notice in the top 4 or 5 indices, which have bet the Nifty by more than 2 times, alpha and low volatility are the most common factors. Alpha itself has got a relative low volatility measure called the beta in its calculation. So it's essentially picking stocks which have got absolute low volatility and moving upward, and picking stocks with a relative low volatility with respect to the market is a wonderful way to select stocks. So it's very intuitive. You pick stocks that keep moving up with low volatility, and you pick stocks which are moving up more than the market. That in the sense that the relative volatility with respect to the market is low. The absolute volatility of the stock itself is low, and it's also moving up. If you it need not produce, all the stocks need not produce return greater than the market, but if you generally hold on to this trend, low absolute volatility, low relative volatility, and of course you also have momentum because they must move up. If you want, you can introduce momentum as well, just to make sure you're not picking a stock that is a stock which is not moving anywhere. Like this will also have low volatility, but it will not produce returns. So that also is a problem. So if you can include that momentum also as a factor, that seems to have worked very well. That doesn't mean it will work in the future and so on. That research you have to do. But in my case, I am looking at stocks which have low volatility and also are generally moving up. I don't care whether they are having relative volatility, my screener has got both these factors: momentum, low volatility, and absolute relative volatility. I don't care too much about the returns. My goals are low absolute volatility, low beta relative volatility, and some momentum. It should not be doing this or going down and still have low. You can have a stock which is moving down but still have low absolute volatility. So it should have some kind of upward movement. So that stock picking is very simple. You don't need to break your head about all these balance sheet factors and so on. That's my goal, and I'm building a large capish portfolio. At my age, that makes sense for me. So that's what I wanted to say. Please explore these indices, do some research, and then start investing. Don't blindly do it. I'll catch you later. Bye-bye.